The next scenario I want to show you is the Excel and the Google Sheets integration. It's something a bit different, but here it allows you to bring data from our platform into your workflow and your Excel. This is a very flexible feature and allows you to do many things. Basically, you build an Excel template and the data appears in it automatically. The Excel can be a stock valuation model, which is what I'm about to show you, but it can also be an option calculator, trade log, a watch list, which we have a template you can download and see. It can have like unique scoring systems, and basically anything you can think of, you can build in Excel and use our data to augment and improve it. So what I'm about to show you here is a very simple Excel model, a valuation model. This helps me understand what is the fair value for a stock, and it's the power for it. It allows me to understand the fair value very quickly. So I am not reliant on an analyst or someone else's opinion. I can understand and get some sort of opinion for myself. And I use it all the time, especially after earnings. So yesterday I used it for Netflix. And everyone were talking about Netflix and stuff like that. But I have the ability to get my own opinion and see how those opinions will play out to the market if I'm right and stuff like that. So the way I use it are two ways. I put my assumptions into the company growth, and then I see what is the fair value, and I compare that fair value to the market price. And the other way is just the reverse way. I use the market price as the fair price, and then I see what is the company metrics needs to be in order to justify that price. So it is a simple model that I only need two inputs, the EPS and the price earning ratio. So the EPS is earning per share, and the PE ratio is price earning. Basically, if you multiply the two, this would be the traded price for the company. So for example, if the company has a $10 EPS and 20 PE ratio, it means that the stock is traded at the 200. Let's just, for example, use Facebook, and I'll show you how it works. So I put Facebook, I'll put what is the current year and what is the expected return I want per year. And then I see, and then all the other information is being imported by Option Samurai. I then go to the EPS model, and the blue lines are, the blue cells are cells that I control, and the rest are being populated automatically. We can see that right now in the last 12 months, Facebook earned about $13.8 per share, and we can see the growth that analyst projects to it. I think that in current situation, it's a bit too aggressive, so I will take it down a bit. And then we can see what is the current PE ratio that the company is traded in. So 14.5, which is pretty much the lowest the company has ever been traded in. So what I would do, I want to see maybe like 10% growth. So I would just put 18 here. So if the company is doing $13.8 per share today, and in 3 years, it will do $18 per share, it means that the company grew 9% per year compounded. And let's say that I think that it's a reasonable assumption. I also think that this PE ratio is a bit low, so I will put 20. Because I feel that this is a fair valuation for a company with Facebook domination and growth potential. So this means that the future price is $360, but that is the price in the future. A dollar in the future is worth less than the dollar now, which is not why the current fair value of the company is $270. And if the market is trading at 188, it means that the company is actually too cheap by 43%, or almost 44%, meaning the company can go up 44% and it will arrive to what I think is the fair value. I also said that I use it the other way around, which means that I use the market price as the fair price. So what I would do, I would try to make the 270, the present value row, equal to 188. So because I feel that the PE is fair, 20 over the long run. So I will say that the company will earn less in the future. So let's see what I need to do. So, okay, if the company will earn $12.50 in 3 years, and the PE would be 20, the fair price will be about the same as the current price, meaning that the market currently projects that Facebook will not grow. It will actually lose money, and that is why it's pricing it like that. So now I would ask myself, is the market correct, or my views are different? And I do think that the company will grow more, which is why I'm bullish on it. But it doesn't matter. Like, I can do this with any stock and kind of get my own opinion, and this gives me an edge because I can compare it to the market, and then I can play. I use the next tool that I show you to play it. Another tool that I have is the sensitivity analysis. So as I said, I need two inputs to put. One, what would be the profit in 3 years, and the other, what would be the PE ratio. But these are estimates that I do. The sensitivity analysis tab is I check how those assumptions are sensitive. So if I'm wrong, and for example, the company will not grow 9% a year, it will grow 5% a year, or 4.6. What would be how cheap or expensive the company will be? So I can see that if the PE is 20 and the company grows 4.6%, then the company is still cheap 26%. So what I can see is that the growth rate doesn't really matter. What matters is what would be the PE ratio. So I can see that with my projected growth, even if we keep today's PE ratio, which is about 15, the company is still a little bit cheap. 8% is still not enough to say that it is cheap, but it is pretty cheap. The only thing that can make it say that, oh, it's expensive, is if the PE will go lower, or if the company will not grow at all, which I need to decide if this is a reasonable scenario and how much do I want to take this risk or not. So basically, that is how I use this model. And if you want, by the way, the template, just email me and I'll send it to you.